We've talked a great deal about insurance on a personal level and everything. A lot of people don't realize, of course, is that life insurance is also very, very useful when it comes to business insurance as well. So business life insurance. So this is a situation really where now we're getting more and more into how can we use insurance products, life insurance products, primarily for people that actually own businesses and everything. And so before we go into that situation, let's look at the three different kinds of businesses that are available out there. The easiest way to set up any kind of business is, of course, the sole proprietor. So as a sole proprietor, basically, you simply start. You can be making widgets in the basement of your house, or whatever, your garage of your house, whatever. It doesn't really matter. The key element here is that as a sole proprietor, in law, there's no distinction between you and your business. In other words, there is no sole proprietorship sort of designation, you might say. Okay, so that means basically that the sole proprietor is totally exposed to any potential liability, lawsuits, things of that nature. So that if somebody sues you, they can basically take your house, take everything, everything you've got, you might say, because there is no distinction in law between what you're doing as a business, let's say, and your own personal life. The other thing in terms of sole proprietorship you have to bear in mind is that the CRA doesn't distinguish you either. Okay, in other words, you are the business, so therefore there's no separate tax filing, let's say, for your business and a separate tax filing for you as a personal. So there's no personal filing, let's say, and then as a business filing. It's all personal, and that's the important thing. It's all basically personal. So in a sole proprietorship, you are essentially it. So if you get sued, if you have to pay your taxes and everything else, you will be really considered as one and the same person. So when you look at the sole proprietor, obviously if that individual should die, you can see the hardship that it could cause the family. So as a sole proprietorship, having disability insurance, for example, critical illness insurance, life insurance are crucial to this individual, because this individual is the actual person who's generating all this income. So if they become disabled, what happens now? The business dies and there's no income coming in. If they have a heart attack or something, the critical illness, or if they die, again, the business is finished with. So there's no continuity, basically, when it becomes to sole proprietorship. So for that individual, this is really insurance is very, very important to make sure that they maintain the lifestyle that the family is accustomed to, and so on and so forth. Okay. The other one is partnership. So if you and I, for example, were partners in all this, so and just for simplicity's sake, let's say it was 50-50 partnership and everything. Once again, in law, there's no distinction between our partnership and us as individuals. So at the end result is, once again, just like the proprietorship, we are jointly and separately responsible for any debt that the company may incur. If the proprietorship gets sued, we both get sued, basically. So there is, once again, no distinction in law between a proprietorship, partnership, basically, and us as individuals. Also, once again, CRA doesn't look at us as different people either. So basically, so even though money may be paid in the general account, let's say, into our partnership, after all of our expenses and so on and so forth, we take out whatever monies we take out. But once again, there is no partnership return. It is strictly, once again, same return that you would have as an individual. So in essence, from the CRA's perspective, even though we're partners, it treats us very much as a sole proprietor from a tax perspective and everything. So once again, the issue really comes down to is that because we have responsibility to each other, think of it as a marriage. Basically, as a marriage, you're jointly responsible for all debts and so on and so forth. For your spouse, it's the exact same situation here. Okay. The corporation, on the other hand, is an entirely different animal altogether. Okay. In a corporation, the corporation itself is, in fact, a legal entity. And a lot of times you probably have seen the word INC, for example, Inc., incorporated, or you might have seen LTD, limited. When you see INC or limited, basically, it means basically that there is, in fact, a company which is a separate legal entity to the owners of the business itself. So once again, I go back, let's say you and I were partners, but this time we are an incorporated partnership. So basically the corporation is sitting up here, okay? And we are in fact employees, you might say, of the corporation. So the corporation now is a taxpayer because it is a separate legal entity. It can sue, it can be sued, all liabilities, everything lies basically with the corporation. So there is a definite difference between, or distinction, you might say, between the corporation and ourselves. Also, because the corporation is a legal entity, they're also a legal tax entity. So you have to file a separate T1 corporate, let's say, for your corporation. And so therefore, it becomes a taxpayer, just like you become a taxpayer, basically. And so it will then issue you as an employee, let's say a T4 for your taxes and everything. So you are essentially an employee of that corporation, and then you would do your own filing and everything. The nice thing about a corporation, of course, is that corporations don't become disabled, and the corporations do not have heart attacks, and the corporations don't die. So here, even though the individuals who may own the corporation actually die or become disabled or whatever the case may be, the corporation itself remains intact. So it is very much of a separate entity altogether. Whereas in these other two situations, if something happened, like they died or heart attack or whatever, it has a direct impact on the viability of the organization. Whereas here, it is quite different because we are, in fact, two separate entities. That all said, one of the most important situations to consider, of course, is it a private corporation or is it a public corporation? For our purposes, we're not going to be dealing with public. This public corporation is a corporation that are listed, of course, on the stock exchange. In our case, in Canada, for example, the TSX, it's a public corporation. We're not going to be dealing with that. We're going to be dealing with a private corporation. So it's a Canadian-controlled private corporation. That's a very important distinction. Canadian-controlled private corporation, okay? We have certain rights under the Canadian Income Tax Act. So, for example, on a Canadian-controlled private corporation, our tax situation, the corporate tax, is much lower than it would be on a personal level. Also, if we ever sold our shares and everything, there is a capital gain exemption for in the neighborhood of $800,000 or more, for example. So there's a lot of benefits to having a Canadian-controlled private corporation, so not a public corporation. That falls into a whole different tax regime altogether, okay? That said, what if we want to turn around and arrange for someone to eventually buy our company in the event that we do become disabled, in the event that we become, that we die? How do we buy out a partner? How do we make sure that there's somebody there at the other end ready to buy our organization? What we do is we set up a buy-sell agreement, okay? So a buy-sell agreement basically says that two parties or more, but an example, let's say two parties, basically, I agree to buy your business and you agree to buy mine. In other words, if either one of us dies, I will buy you or you will buy me, depending on who dies first. So if I died, you would buy my half of the company. Let's say it's a 50-50 split. You would buy half of my shares. Let's say if you died, I will buy your half. So the buy-sell agreement is a binding buy-sell agreement. In other words, the whole essence of a binding agreement, okay, is that that one will buy and the other one will in fact sell. So we've got a situation here where we have a guaranteed buyer. We now know exactly who's going to buy in the event that I should die. We have a guaranteed buyer. There's somebody there waiting to buy my company. The guaranteed seller, me being disabled, I will sell to you. I'm not going to sell to anybody else. Okay, I'm not going to allow a third party to come in. There will be a situation where I'm bound by the law, basically by our contract, that you're going to buy me out and I'm going to sell to you, and I can't sell to anybody else. Okay. And I've also got a guaranteed value. In other words, we establish a value for the company. Of course, these values can change over time, and then, of course, the agreement will be changed accordingly. But basically, I have a guaranteed value. So really what the buy-sell agreement, the binding buy-sell agreement, gives a lot of peace of mind, you might say, to successors. So if you have family, spouse, kids, and all these things here, something should happen to you, they know automatically that there is already somebody there at the other end that will, in fact, buy the company. And not only will they buy it, they will buy it for a certain amount of money. So the succession planning part of all this is very, very, very important. Okay, so everybody that owns a company, one of the concerns they always have is that, well, what if I become disabled? What if I die? Who's going to be there to buy me? Well, by having a buy-sell agreement, a binding buy-sell agreement, you've answered that question, because there is a guaranteed buyer, a guaranteed seller, and of course a guaranteed value. So then you say, okay, that's fine. We have to fund all this. Okay, we have to fund it. Like, where's this money going to come from? It's one thing to say, yes, we've got all this, we've got this great agreement and everything else, but what if there's no money to buy it? Obviously, then the answer here is life insurance. Okay, what we will do is we would insure the two parties involved, or whoever is involved. Basically, we would insure those individuals, so that way the money will be available when it is needed most, and obviously needed most when the person dies. So the next question then is, how do we do that? Well, there are a number of them, and there are three in actual fact ways of doing it. The first one, and very, very common, is what we call a crisscross arrangement. In a crisscross situation, what happens is I will insure your life, and you will insure my life. So let's say the company's worth $1 million. So I will insure you for $500,000. So I own the contract, and I'm the beneficiary, okay, on your life. And you then own a policy on my life for $500,000, and you're the beneficiary of the policy on my life. So that's what they refer to as crisscross. So the two of us now are fully insured. So I die, so now you're the beneficiary of the $500,000. You get that $500,000, and now you go to my spouse, let's say, and you say, all right, here's the $500,000. Essentially, give me the keys to the shop, you might say, and now I become the owner of that business. Okay, so very, very effective, particularly in terms of partnerships and everything else. So if we have a 50-50 partnership, whatever, I buy on you, I buy on you, you buy on me. Because remember, it is a binding agreement. So it isn't a situation where I could turn around and say, okay, well, I've got the $500,000. I think it'll go away. I'm happy with my $500,000. No, I have to use that money to buy out your shares, okay, your half of the business. So it is a binding agreement, because otherwise it violates all of these conditions and everything else. So in a crisscross arrangement, you're buying on me, I buy on you, I die, you get the check, you then take that money, go to my spouse, here's the check, she gives you the keys to the shop, and now you own the entire business, and that's the end of that, okay? So it's a fully funded buy-sell agreement. The next one is what they call cross-purchase with a promissory note. This is when we're using a corporation. In a corporation situation, we actually have two ways of doing it. In a cross-purchase promissory note, what happens again, in this case here, it is the corporation that, in actual fact, owns the insurance policy, and the corporation is, in fact, the beneficiary. Okay, so here it's a corporate situation where the corporation, let's say, owns a $500,000 life insurance policy on my life, and the corporation is the beneficiary. So, once again, I die, and what will happen is at the time of death, you, as the living person, the living partner, and everything else, will issue a promissory note to my estate, basically, okay? Because remember, when I die, everything goes into my estate. You're going to want to buy the shares from my estate. And so you're going to issue a promissory note to my estate, let's say, for $500,000. Okay? Remember, the recipient of my estate, of course, is my spouse. Okay, but nonetheless, you're buying the shares from my estate for $500,000 promissory note. Now, the money gets paid. Okay, the $500,000 worth of life insurance actually gets paid to the corporation. You will then, as the owner of the business, remember, you bought the company now. You now have it because you did have a promissory note. So you own the company now, okay? You have promised to pay, and that's all there's to it. Okay, so now you own the shares, basically, of this company. A cash infusion of $500,000 comes into the company. You then declare a dividend. Okay, you declare a dividend, basically for $500,000 to yourself. You take that $500,000, you go over to my spouse and you say, I want to cancel the promissory note. Here's the $500,000, and that's the end of that. Okay, so now you own the company and there's no debt to the company. Okay, so you originally bought the company using a promissory note, but you obviously don't want to carry that forever. So as soon as the money arrives from the insurance company, let's say, you will declare a dividend to yourself for $500,000. Take that $500,000, go to my spouse basically and say, here's $500,000, and the promissory note is now canceled. So my spouse has the money she needs, okay, and you of course have canceled the promissory note. So all is well, okay. So that is using a promissory note to actually buy, but this is, remember, is used by corporation, whereas in a crisscross is primarily for partnerships is the primary thing. The share redemption is very similar to the cross-purchase promissory note, except that here what happens is that the company owns an insurance policy on you, and the company also owns an insurance policy on me. And the company is the beneficiary of both policies. So basically, the company owns a policy on myself, and a company owns a policy on you, and the company is the beneficiary of both. So the buy-sell agreement now is between the company and me, and the company and you. Okay, and so I die. What happens is the money, the $500,000 gets paid to the company, and then the company declares a dividend. Okay, declares a dividend to my spouse. It isn't, the dividend is not yours. This is a promissory note type of thing, okay? The dividend is now declared to my spouse. And my spouse now has the $500,000, and she hands over the shares to the company. And that's why they call it share redemption. Sometimes you'll see the word corporate redemption. It's the same idea. So basically, in this case here, is the company who's actually redeeming those shares because it gets the cash. That cash then will be used to sit down with my spouse, and she hands over the shares, let's say, to the corporation, and she gets the $500,000. And once again, you own the company. Okay, so these are the three mechanisms basically where we can use life insurance to fund that binding buy-sell agreement to make sure that we meet these three criteria and everything. Now, I indicated to you that the money going in from the insurance company is paid obviously tax-free and everything. How do we get the money back out again tax-free? Because we don't want the money obviously to be stuck in corporate taxation and so on. So in other words, it's not part of the general income and everything. We want to make sure that it continues on being tax-free. And so therefore, this is very important to remember, is that all private corporations, not public corporations, but all private corporations have what's called a CDA account or a capital dividend account. A capital dividend account is simply a notional account, doesn't really exist. So the $500,000 is payable to the XYZ corporation, whatever. It sits there in this notional account called a CDA account. But because the word capital dividend account, okay, that means that the money that gets paid out from the CDA account is tax-free. And that's an important thing. So money coming out from the capital dividend account is, in fact, tax-free. If you remember in a previous session, we basically said that 50% of the capital gain is tax-free. Well, that 50% will go to the CDA account, and once again, it will be paid out, let's say, to the shareholders or whatever, tax-free. It's the same idea here. So the life insurance policy is paid to the company tax-free, and because it's sitting in a notional account called the CDA account, that money then will be then declared by the board, basically to be paid out to the deceased shareholder's estate, whoever's representing the deceased shareholder's estate, and it will be a tax-free dividend account. So that's a very important concept to remember. Okay. The next thing we might want to look at is what we call split dollar insurance. And this is usually used for key person insurance, okay? So let's say that besides yourself as the owner of the business, you have a particular employee who's very, very, very important in your operation. And in the event that that individual should die or whatever it is, you're going to suffer severely financially and everything else, okay? You could, in fact, buy a life insurance policy on that key person so that that individual dies, you're going to get that cash. So you will own the policy basically sitting here. They're the life insured and you're the beneficiary. So the person dies, $500,000 goes to the company, and that $500,000 will be used to mitigate possible losses because you've lost a key employee, basically. So you may want to make sure, you may have to hire somebody. It takes time to train that individual. In the meantime, all that time is dead time, basically. You may lose business. It may cost you a lot of money to retrain somebody. Where are you going to get this money from until the person becomes fully productive? So it could be a very serious situation. So besides yourself, you can have a key person who's very, very key in this operation, and therefore, the loss of that individual could severely curtail the success of your company. So just like you insure your building and you insure your equipment and everything else, you should also insure the key person, the person that actually makes all this happen. It'd be a good idea to have them insured as well. So that is a key person insurance. But you can also do what's called a split dollar with that key person. And it's basically, as the name says, a split dollar. You can have a situation where, for example, the life insurance premium, the life insurance portion of universal life, and primarily works with universal life, where the life insurance portion of universal life is actually paid by the employee, because the employee then will have his spouse as the beneficiary. So you're not the beneficiary here. And the cash value in the policy will be paid by you as the employer. And so what you've done is you've split the dollar. So let's say, for argument's sake, it's a $10,000 premium, and $2,000 of that is the cost of the insurance. So the employee pays the $2,000. The other $8,000 is paid by you. That goes into your account, invested, and so on. As you know, with universal life, you can do those kind of things there. So, in the event this individual should pass away, the $500,000 life insurance portion will go to his spouse, because that's how you split it. And let's say there's $100,000 worth of cash sitting in that policy. That policy will be paid to you. Okay, and so therefore, what have you done? You have split the dollar. You can also do, of course, the reverse. It could be a situation where the cash value will be paid to the beneficiary. Basically, that $100,000 could go to the employee's spouse, okay? And you keep the life insurance portion because you may need that instead. So how you set this thing up is really according to your particular needs as the corporation. The point is, it's in a split dollar situation. It's really a partnership, you might say, where you've got joint ownership of the contract, and depending on how you set it all up and everything else, both parties could in fact win. Okay, so this is very, very common when you're trying to reward, for example, a key person in that you want them to be properly insured, so that in the event that they pass away, their family's well taken care of. At the same time, you want to take care of your own business as well, and so on and so forth. So at the end of the day, a split dollar type of arrangement is a very, very good way of financing essentially the loss of a key person. And we'll leave it at that for now, and we'll see you shortly.